Welcome back. As we tape this, we're right at the end of March, entering early April, and this is the time that we can be joined by our tax expert, Greg Porcaro from Atrondo Porcaro Associates in Warwick, Rhode Island. Hey, Greg. All right, so it seems like we might be having a little difficulty, but as we kind of work through that, okay. Greg, you can hear me okay?
I can.
All right, great. Okay, so there's a reason why that you are mobile or not mobile. You're not here, and it's because you're in the middle of tax season and things are crazy. And, you know, to start out with, you know, I always think about there's always big errors in tax preparation, but we've talked about this, that there can be simple errors that can really hold things up. Can you tell us what some of the common ones are out there, and maybe that'll help some of the people that are doing their taxes?
Sure, Robin. I would have loved to have been there with you in the studio, but they actually had me chained to my desk, so I barely get a chance to eat here. But this is really important. This is that time of year, and I think this is a timely topic as we approach April 15th, 17th, or 18th, or 19th, depending on where you live. And I think it's important because a lot of people procrastinate. So this is a really critical time to give some thought to this, because as we approach the deadline, sometimes we become more anxious and maybe more likely to make mistakes. Obviously, one of the things you could do to eliminate some of that is to hire a tax professional, whether it's a CPA or enrolled agent, people with the experience. There's a lot of intricacies that complicate a return. And then there's the basic things that really can delay the processing of a tax return. The most basic is having the correct Social Security numbers, particularly if you have a new child. Make sure you put the right Social Security number as a dependent so that you'll get credit for the dependent. And if you're filing your return electronically, you'll know right away because your return will get rejected if the Social Security numbers don't match up. But if you paper file, and some people still do, it will take a while before them to figure out the return's not correct, and it will totally delay the processing, which, as you know, based on prior conversations we had, is already a problem, right? We anticipate delays in processing. Another one that we see that's an easy one to fix is making sure that if you have a child that's old enough to work, that they don't file their own tax return without telling you and potentially claim themselves, which they shouldn't do because they're still a dependent, but that will really delay your return. If you attempt to claim that child, they're not going to accept your return if you file after your child. So this happens all the time. Your kids are away at college, they file their return on their phone, and mom and dad try to get a return filed, and it delays the whole process. Now you got to fix the child's return. It's really a nightmare. Just misspellings could be a problem. What we found after the last couple of years where people were trying to apply for grants, et cetera, if their names on their tax returns didn't actually match to the letter of their Social Security number or federal ID number, the SBA couldn't process an application, even though it could have been over one letter.
Like with a middle initial, does that ever become an issue, or it's more first, last name?
Middle initial, if that's what's on your tax return or on the way you file, it has to match everything else. If there's a third party trying to verify with the IRS whether you filed or not. So this could be for a loan application, could be an SBA loan, a mortgage, et cetera. So we found that to become a bigger problem than it used to be. So even those basic things will help avoid, you know, long delays.
Yeah, you know, there is one thing that I was thinking about that, you know, has come up with a client or two, is if you had, you know, husband and wife that are separated and one can actually take the child as a dependent, but for some reason, whether it's by accident or not, the one who shouldn't be taking it takes it, files first. How can you unwind that, or like how does that kind of play out?
So, you know, that's back in, I think it was 2008, they changed the rules relative to claiming dependency in the situation of a divorce. It used to be that as long as it was incorporated into your divorce decree, that would be verifiable proof of who is entitled to claim the child as a dependent, assuming the child qualified as a dependent. So you have to qualify as a dependent, right? So I don't want to get into that marsh right now, but now you have to make sure that the person that's going to be waiving that exemption has to file a form 8332 at the time, ideally, when the divorce is finalized. So you get them to sign if it's for all years or alternating years. That's the proof that you might ultimately need to convince the Internal Revenue Service who is really entitled to claim this child as a dependent. That is a real hassle to try to do.
I'm sure the coordination of it, and you know, it's going to delay everything, correct?
Right, especially if the parents, can't communicate, right? So it becomes even more difficult if there's no basis for communication.
All right. Some of the stuff you mentioned was some basic stuff. What are you finding as some commonalities that maybe it's a little bit more advanced of an issue where you might have some more complicated problems on the returns?
So 2021 is a good year for that because we have that new child tax credit. We had some stimulus payments. There were changes in the earned income credit. It's very complicated. And so if you're not aware of what those things will be and how they impact your return, the IRS has an excellent interactive tax assistant at irs.gov, where you can work through what you might be entitled to if you're trying to do your own tax return. Even using TurboTax or some other, tax processing software, you want to be aware of what you're eligible for as you're entering in the data, because just not entering the data incorrectly will cause problems and you can miss out on some substantial benefits. So that's a key one, is to be aware. And that's why I think, again, using a professional will help, because they should be aware of the things you might be entitled to get. And, the other thing that we're seeing a lot of problems with, frankly, Rob, is bank account information not being properly entered. So if you have if you're in direct deposit or direct debit, if you have a refund or owe, and you don't put the right banking information in, the return's not going to get processed correctly. And then to try to recover that money takes months. So you have to file a separate form, 3911, and say, hey, I didn't get my refund. It could take you a long time. And obviously you want to make sure you pay your taxes on time. So again, if you don't process it timely, the payment's going to be late, and now you're going to be assessed penalties for making a late payment. So make sure you use the most current, accurate banking information, and that's the account that'll have the money in it if a payment is due, and a place where they can put the money if money is owed to you. We find that to be like a real potential problem.
Okay. You had mentioned something about looking at last year to this year. Do you think that's a good way to double check yourself to some degree? Obviously, laws change and your situation changes. But if you have last year's return, is that a good rule of thumb in a sense to give you some comparison?
Well, internally, what we do, it's part of our process for review, even for clients we've had for years, is we look at the prior year return while we're preparing the current year to see, because many returns are relatively similar from year to year. Unless something happened, they got divorced, sold a business, bought a house, whatever, things change, like you said. Yeah. So it's really important to have a perspective of what happened, because if you're doing your 20, and this happens, like we see it happen in real life here in the office. You prepare the 21 return and you look at it and like, that's not what I expected. And you look at 21 and say, what's different? Why are they not consistent if there's not something you actually know about? So that's a really, really good indicator that you're on the right track.
Okay. If
nothing materially changed in the year.
Okay. Switching gears a little bit off of this year's tax return and more of maybe a tax issue that I see with my clients, and I think it is pretty common, would be, someone that's going into a retirement. So let's say this year they're thinking of retiring on July 1st, and they're no longer going to be working, not having a W-2, but now they're going to draw from Social Security, pension, and possibly an IRA. In those situations, and if you could tell me, what's the best way to do it? They're like, all right, who do I call? What do I do? And I think Social Security for me seemed like the more difficult one out of all of them. But if you want to withhold, number one, how do you know how to withhold, like the certain amount? And then what are some ways in which you can make sure you can convey that so it's done when you get paid?
So this ties right into the issue of preparing your 21 return, because when you're preparing your 21 return, it's in 22. So you know what might be coming, and you have to consider that as you finalize your 21 return. And this happens all the time. And I can't tell how many times when we sit with people who are going through that specific transition and saying, what's going to happen? So what we do is we model what the 22 return in this case would look like based on their expected retirement date. So how much will they earn in wages up until the point of actual retirement, including any unpaid vacation time, severance, et cetera. And then what do they expect to see for income, whether it's Social Security, required minimum distributions, whatever the case might be, and being wary of the age factor, right? So if you're retiring luckily before 59 and a half, you've got to be sure that you try to defer taking out that 401k or retirement money to avoid any potential penalties. But we actually figure out exactly, to the extent we can, what's going to be due. What are you going to pay in through your time of employment? What's going to be due for the additional income, Social Security, et cetera? And what's going to be that gap? How much and how are we going to make it up? And we can make it up two ways. Make sure there's adequate withholding at the source, whether it's Social Security or from the 401ks, et cetera, or making estimated payments for the remaining portion of the year so you're not stuck with a large liability and potentially penalties for not paying in enough tax during the year.
Do you find most people will withhold at the source rather than make those quarterly payments because it's just automatic?
You know, it's funny. I had a conversation with a gentleman just yesterday on this very issue, right? He's retired, and we talked about it. And his view was, I'm going to keep my money month to month as long as possible, and every quarter I'll make a payment. So we project his income, give him an estimate, and he pays every quarter. And if you have the discipline for that, I think that makes a lot of sense.
No, I do too.
Not everyone has the discipline. So withholding at the source is easier.
Yeah. As we close out, you know, if we're kind of, and we are inching, and I don't know when this will air because it airs a few different times, but if you're getting close to that deadline, first of all, tell us what the deadline is here in Rhode Island and maybe Massachusetts. What can we do if we just don't feel like we're ready, or we're like, you know what, I can't do this myself, I need a CPA to help me?
So for Rhode Island, it's April 18th, and for Massachusetts, it's April 19th. In my mind, it's April 15th, just for the record, right? So in any event, if you get to that point, make sure you file an extension, federal and state. Make sure you try to figure out, if you do think you owe money, you're better off sending in the money with the extension, because the extension does not give you time to pay, just file. This way, in case you happen to owe money, you don't get penalized. And in Rhode Island and Massachusetts, they have a rule where if you don't pay 80% of what you owe, your extension's invalid, and therefore you're filing a late return, and those penalties are much greater. So unfortunately, worst case, just file the extension, right? If you have no idea what's going on. If you have some idea, pay what you think you owe, or as much as you can, so that at least you have a validly filed extension, federal and state, and then circle back soon thereafter to try to wrap it up. So if there is a liability, it's not accruing interest, you know, between now and October 15th, when the filing deadline is actually over for 2021.
Okay. We appreciate you taking the time out of your busy schedule at this time of year to help us. I think this stuff was very helpful to our viewers, and we'll look forward to seeing you after tax season. Thanks, Greg.
Likewise. Thank you.
When we return, we will talk about annuities. Stay tuned.